Amazon and shoppers are preparing for Prime Day sales on Monday. You know what's not on sale? Amazon stock, which just passed $1,800 a share. The e-commerce giant hasn't had a stock split in almost 20 years. So when will investors get their deal day? Our Bob Pisani is at the New York Stock Exchange with more on this story. Hey, Bob.
Hi, Melissa. Companies still typically split their shares to make their stock more affordable to retail investors. Now, stock splits peaked in the late 1990s when the dot-com era drove tech stock prices up dramatically, then gradually rose until the financial crisis again, and they dropped dramatically, and they never really recovered. So why don't companies split their stock as much as they used to? Well, much of it has to do with the predominance of institutional investors like Vanguard and BlackRock over retail investors. They own nearly 60% of Amazon shares, 72% of Google shares, 80% of Netflix. Institutional investors don't really care if a stock is high priced or not. They may be perfectly happy to have it high priced because it discourages day trading that introduces volatility. You know, that's Warren Buffett's mentality. He said for years he has no problems with the company's stock price going up and doesn't care about stock splits. For him, it's more about the dollar value of what's being bought. So, for example, if he wants to get $1.8 million in exposure to Amazon stock, he's perfectly happy to own 1,000 shares at $1,800 as he is to own 10,000 shares at $180. It makes no difference to him. Another point, the number of what I call super price stocks, those over $300, is still relatively small. There's only 23 of those in the S&P 500. That's about 4%. Including well-known names like Alphabet, AutoZone, BlackRock, and Netflix. Stock splits still do happen, though. You know, Apple split 7 for 1 back in 2014. It's up over 100% since then. Netflix split 7 for 1 in 2015. It's up more than 300%. And this begs the question, by the way, will Amazon be next? Back to you, Melissa.
All right. Thank you so much, Bob Pisani. So, should Amazon split? Tim.
Well, look, I mean, this whole concept of the guy who can only buy 2 shares and not 3 shares of Amazon is the one that's keeping the market from tumbling by not being involved, I think is ludicrous. And if you also think that it's about price weightings effectively, then you think that the Dow Jones is ludicrous, frankly, because that's a price-weighted index. So, no, I don't think Amazon should do this for the sake of throwing a bone to their investors. Their investors are getting all they need. This company continues to execute. The biggest issue right now is certainly the valuation. People believe every sector that they enter and want to dominate, they're going to, and I think the healthcare boost in the last couple months is a big part of this. Stay along the stock.
I mean, it seems like ETFs would have a bigger role in this whole thing, right? I mean, you could still buy $179 share of QQQ.
Right.
And you'll own Amazon, a lot of Amazon, and you'll own a lot of FANG.
In the Spiders Select XLYs, the consumer discretionary, Amazon is 23%. So if you want to own something, if you want to get exposure there, also you have Netflix, it's about 6%, a little less than 6%. So there's ways of doing it more affordably. But for the stock like Amazon, it's outperformed the S&P 10 to 1. Basically in the last 10 years. So tell them they're doing something wrong. So I don't think it's a great idea for them to split their stock.
I don't think there's any reason for them to split. I mean, generally, you would split it so you maybe get some more retail interest, which would bring more liquidity. But Amazon has had no problem with liquidity. They don't need to do anything. Their stock keeps going up. So why change it? Ain't broke, don't fix it.
Well, you know, there's some splits that really led to a big run-up in the stock. Netflix was
Apple.
Apple's was effective.
Exactly, right.
Apple's was, I mean, I think Steve you touched on something in the question Steve has answered. ETFs, to me, it's great on the way up, and everything works really well on the way up. But God forbid the market were to swing and start to go lower. The sell-offs vis-a-vis ETFs and the underlying stocks could be sort of nasty.
We have no idea. Let's face it.
We have no idea, and I think that's a real concern.
Yeah, I think since this market, there's been ETF-ized, if I may. I just did. Ultimately, I don't think we've seen really the move that we're going to see, and I think the dysfunction on a lot of these down days, it's very clear it's ETF.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.